Welcome to Understanding Corporate Accounts with me, George Turner from Finance Uncovered. Not the most excitingly named presentation in this conference, but hopefully one of the more useful. If you are interested in looking at companies, if you are interested in looking at flows of money, corruption, any kind of finance-related subject, you really should try and get comfortable with looking at company accounts, because they are the kind of foundation for a lot of this work. And in England, we all stop learning maths age 16, unless you choose to do so. So there's this kind of inbuilt British fear of numbers, and people just say, "Oh, I can't do that. It's too hard." But obviously, I don't have that issue here because you guys invented numbers, so I assume you're all very comfortable with numbers. So, little summary of the kind of things we're going to cover. We're going to look at the different parts of company accounts. Company accounts come in different, they're structured in a kind of formulaic way. You have a set of written reports, you have an income statement, a balance sheet, a cash flow statement, and a notes to the accounts. And we'll look at all of them, what they tell you. I'm going to try and draw out the kind of information you can look at these accounts, some of the kind of stories that I've done in the past based on information I've found in corporate accounts. And so to maybe give you some inspiration for the kind of things that you could find as well. And we're going to look at cooking the books, why people commit accounting fraud, and go over some basic principles of accounting fraud for non-practitioners, and look at some offshore companies, because I don't think it would be complete to look at company accounts without kind of mentioning this big black hole in the international financial system, which is the offshore companies. I won't talk too much about tax avoidance because that's the subject of the presentation tomorrow at 11:15. Be there or be square. Right, so a couple of words about Finance Uncovered. What we do, Finance Uncovered is a not-for-profit investigative journalism training and reporting project. We started a few years ago putting on workshops for people to learn about financial reporting. The aim was to improve the quality and the quantity of reporting on illicit financial flows. And we held a workshop twice a year in London for 4 days, brought people in, accountants, financial professionals, people involved in law enforcement, as well as investigative journalists, to teach investigative journalists the kind of basic things I'm going to go through today. And through that, we built this network of people that had been trained, and we start working with them to develop stories. And now we've kind of developed into a 5-person operation based in London, and we're kind of going global with our courses. So we are doing a course in Indonesia at the beginning of next year, and in Nigeria, and as well as the ones in London. So as part of that, if you, I hope my email address will be at the end, but if it isn't, I will give it to you. And if you want to, you're working on a story in the future and you come across stuff, you're always very welcome to email us. If we can't help you, we'll try and find somebody who does, who can. We also might be able to put you in touch with journalists working in other parts of the world. Finance, one of my mottos is, finance has no borders, so neither should we, right? So, it may be you're looking at a company which is operating in your country, but is based somewhere else, and you might need somebody to help you run down something somewhere else. We might be able to put you in touch with that person. So before we go through these things, I'll just talk a bit about the sources of information and where you can get hold of corporate accounts. So, the key, the two most helpful tools, I think, are the OCC RP Investigative Dashboard and Open Corporate's website. So the OCC RP Investigative Dashboard has a very, very helpful list of all of the company registries in the world. Yes.
Can I just raise one question? Will those be available so that the slides?
Yeah, I can make the slides available.
Okay.
Yeah, and it's also being live streamed, and there'll be a video, and watch it with your friends. So OCCRP Investigative Dashboard has a very useful list of lots of countries in the world where you can find information and what information is available, links to the websites of the stock exchange or the business registry and so on. So if you don't know what is available in a country, if you go to the OCCRP Investigative Dashboard, that's really good. Open Corporates is a website which tries to kind of build a unified global database of all of the companies in the world. I mean, it's not comprehensive because they can't get the data in some places, but as where they can get data, they try and put it all in one place, which is really useful because it means that if you know of the existence of a company, you might know the name of a company, you can put it into Open Corporates and it will tell you, which names come up in the databases that they link with, and it will provide links to the registry. So if you were to look up, Finance Uncovered, for example, it would give you the link to the British corporate registries page where Finance Uncovered's filing data is on the Open Corporates website. And it would do the same as well if you were looking at the a Dutch company and so on. So it takes you to all the specific pages of where a company is registered in any particular country. Now, you then want to look at basically most countries in the world will have some sort of business registry where companies have to register their data. They have to go in and file something, even like a yearly thing, just a certificate to say they still exist. Sometimes they'll be online, sometimes they're not online. But in the UK and Britain, they're all online. Every company in the UK is accessible through Companies House website. And Luxembourg, interestingly, is all online. You can go through Luxembourg. Belgium, they are all free online tools. Places like the Netherlands, you have to pay for, but it's a fee of a few euros. It's not very expensive. It can get expensive if there's a lot of companies you start looking at in these places. But yes, it's something to think about if you're starting an investigation, because even though you may be in Syria or wherever, a lot of people use UK companies wherever they are in the world. So we actually started looking at in the office how many people were registered in Companies House as a director of a company but had a nationality which wasn't from the UK, and you're looking at maybe I think 1,000 people, a few thousand people from Russia have UK companies. There's a whole list of them. On that theme, stock market filings are really useful. So the United States possibly has the most aggressive laws when it comes to enforcing the disclosure of data by stock market listed companies. And if you go to the US stock market, stock exchange, Securities and Exchange Commission website, sec.gov, and they have a search tool called EDGAR, you'll find all the details of every company which is listed on a US stock exchange, and the amount of data they have to give is comprehensive. In Canada, it's called CEDAR. Canada is interesting. Lots of mining companies are listed in Canada, even if they operate globally. Same with Australia. So you might want to look at those places. And then local stock exchanges as well. If someone's listed on a stock exchange anywhere in the world, they really should have kind of higher level of disclosure than a private company. So, I've looked at companies in Egypt, for example, using the Egyptian stock exchange website or corporate websites. If a company is stock market listed, usually, in the UK, the law is that you have to publish your accounts on your own website. if you're listed on the UK Stock Exchange. I think in other countries they will tend to do that as well because they're trying to look for investment. So they're trying to look for people to invest in their company. They'll try and put stuff on their own website. So I'll talk a bit later when I did some work on Orascom, which is a big Egyptian conglomerate, and I found lots of stuff on their website. So when you get hold of your company accounts, right? So companies have to publish their accounts, and there's basically two parts to a company accounts: the bit that they have to publish, and the PR, the kind of advertising. And if you get a company accounts from a company, it might be a document this thick, like an annual report, and the bit which they have to report or they have to publish is always towards the back. And then you might have like 200 pages at the beginning of glossy charts and big numbers and nice corporate pictures of the management and big smiley faces of all the customers. They're so happy. They love buying stuff from this company. And all of that stuff you can just kind of go straight past and ignore, really, because it's what the company wants you to. It's the best gloss they want to put on their accounts. If a company is in trouble and it's about to run out of money and is about to go bankrupt, they're not going to be like, yippee, we're about to go bankrupt, yay. They're going to be like, oh, this has been a challenging year. But we have high hopes for the future. So just ignore all of that. And then you go to the back, and then you have these sections which I'm going to go through, which are the kind of statutory accounts. They're called statutory because the companies, by law, are required to publish them. And the first part of them is the written reports. There's a set of written reports, like writing. And one of the first one you get to is the auditor's report. But they're not always in the same order. But basically, one of the first ones is the auditor's report. I'll deal with in a second. But also the director's report. And the director's report is the kind of directors. Sometimes it's the chairman's statement. Sometimes they'll set out in a kind of written form their description of what happened over the year. Company accounts are always looking at the previous year. I mean, this is a problem because the information you're getting is by definition out of date. And often company accounts will be reporting many months after the date of the accounts. So the accounts will run for a year. So it might be 31st of March would be the accounting date. So let's say 31st of March 2015 to 31st of March 2016, and then they publish those accounts in October. So in October, you're getting the accounts from 2015 to March 2015 to March 2016. So there's a lag. But the director's report will be kind of looking at, describing the performance of the company for the year, sometimes the strategy, and so on. And this can have some very interesting stuff in it. So this was, I did a big project looking at football clubs and their accounts and their sources of finance. And this is the director's report from the year ended June 2014 for Bolton Wanderers. None of you are going to be able to read, I don't think, any of this from out there, so I'll do it. But it starts with this kind of subheadline, going concern, which is always a concern. Going concern basically means that a company is a going concern if it meets its liabilities over the year. So if it knows that it owes suppliers, for example, 50 million pounds, it's a going concern if it knows it can generate that cash to pay the suppliers. And if they are highlighting that there's a going concern issue, that means the company is in some trouble. So here it says, the company is currently dependent on funding from Moonshift Investments Limited. I mean, Moonshift Investments is not a strange company name at all, but it's Moonshift Investments is a British Virgin Islands company which is associated with the owner. It says, an associated company of the ultimate beneficial owner, the Fieldrell Private Trust Limited. In determining the appropriate basis of preparation of this report, the directors are required to consider whether the company can continue in operational existence for the foreseeable future. That is for at least 12 months from the date of the signing of this report. So that's what I said before. The directors have to give an opinion to say,
You can speak a little bit slower.
oh, okay. Sorry. So the directors every year are required to give an opinion to say whether they think the company will be in business at the end of the year. So it says the company meets its day-to-day working capital requirements with a combination of a £170 million long-term loan and a £4 million short-term bridging loan from Moonshift Investments. And then it talks about some bank loans it has from Barclays Bank. In ensuring the company has sufficient liquid resources to meet its liabilities as they fall due, so it's got a bank loan that has to come in and they have to pay back the bank loan. The director have reviewed in detail the cash flow projections under a number of different scenarios. After having taken into a range of possible outcomes arising from on-pitch performance, so how well the team does during the year in the league or cup. The forecasts and projections adopted as a basis for going concern show that a further funding requirement in excess of the current level of funding facilities immediately available to the directors. Therefore, the directors acknowledge a material uncertainty in the event that the company's ultimate beneficial owner becomes unwilling at any time to continue to provide funding support to the business to the general level that it has done so for many years. So this, as you can see, if you see a company's annual accounts, as I said, it'll have big numbers, nice corporate pictures, happy customers. This is written in very boring, very small text in language which is difficult to understand. But essentially what they're saying is we've run out of money. This could be summarized by we've got no money left and we're losing money and the bank is about to call in our loan and it's game over. Unless, which is the last sentence, the owner steps in and provides some more cash. And what was happening at this club was that they were losing, they'd spent, I can't really remember to be honest, but I think what happened is they'd got into the Premier League and they'd spent a load of money on players in order to keep into the Premier League, and then they'd dropped out. And so lots of money that they would have got from TV and so on wasn't there. And the club was losing about £50 million a year. And this was being funded through these kind of offshore companies based in the British Virgin Islands, which is a very precarious situation to be in, because you can't see the financial position of the Moonshift Investments or the companies in the British Virgin Islands. British Virgin Islands companies don't publish their accounts. So what they're saying is we're dependent for the life of this company is dependent on the financial strength of a company which you can't see the finances of. So you just have to trust us that the owner's going to. Anyway, what happened was the owner ran out of money. He ran out of money, or he stopped wanting to throw money at this big black hole. And the tax office gave them a tax bill which they didn't have the money to fund, and they almost went into liquidation, into bankruptcy. They got bought out at the last minute, but literally they were kind of seconds away from the company being put into liquidation, i.e. an administrator taking over. And this was a football club which was one of the founding 12 members of the UK Football League. It goes back to the 19th century. It's a very, very long history. So it's quite a sad state of affairs when these kind of companies die like that. So as part of the written reports, sometimes you also get what's called a remuneration report. This tends to be with the larger companies. They write a report about how much the directors are making in terms of money. The disclosure on this varies between different countries and different jurisdictions. This is the report from Royal Bank of Scotland in 2008. So in 2008, Royal Bank of Scotland, in October 2008, the UK Chancellor was told that the bank had enough cash to continue for operating for the next 2 to 3 hours. This was one of the largest banks in the world at the time, and it was thought that if in 2 to 3 hours they ran out of money, the entire financial system might come crashing down. Then the UK government initiated a £45 billion bailout. It was the largest in history for a bank. And Sir Fred Goodwin, who's the second guy down on this list, he was the top guy at the bank in that year. And if you see, I think this is to do with their pensions. And he had to leave because the part of the deal was he left of the bailout, and his pension was worth £16.5 million, which he got to keep. And there was obviously a lot of controversy because people thought that if you're the person responsible for crashing the economy and putting a £45 billion liability on the government balance sheet, then maybe you shouldn't get to keep your £16 million pension. But there you go. This is a remuneration report for a company called Berkeley Homes, or Berkeley Group. Berkeley Group is one of the biggest house builders in the UK. So if you see all of these large towers full of luxury homes that are being used to stick money in from all over the world, they're normally built by Berkeley Homes. What they've done is, it used to be the case that reporting on pay was incredibly complex because you had these kind of short term, you had like the salary, and then you had like long-term incentives and bonuses, and they all kind of happened at different times. So it was very difficult to kind of see what the actual pay of somebody was in any one given year. And what happened is, to get around this, the financial reporting people who come up with the rules came up with the idea of the single line reporting, which is the kind of total thing at the end here. This is total. And you can see here that this guy, Anthony Pidgley, who's the founder of the company, in 2015 made £23 million in 1 year as the head. And this was mostly down to a long-term incentive plan, which crystallized in that year of almost £20 million. And this is just a huge amount of money for one person to be earning in 1 year. I mean, if you think, £1 million would transform anyone's life. And this guy's got 20 in 1 year. And we'll come back to why this is interesting in particular later. Other things that you can pick up which are interesting. This guy here, Nick Simpkin, he's got nothing in 2015. And if you look at the note here, it says that he just left. It just says, left the board. No explanation. He was the company's finance director and just suddenly left. And there wasn't a lot of reporting at the time about why that happened. But this is the annual report for 2015. In August this year, Berkeley Homes released their current annual report for 2018, and it contained the following. It says payments to past directors. During the period, the company settled the proceedings brought by Mr. Nicholas Simpkin, its former finance director, in the Employment Tribunal and the High Court. Under the settlement, Barclay made a payment of £4.95 million to Mr. Simpkin and a further payment of £4.55 million towards his legal fees. On being dismissed by the company, Mr. Simpkin's options over 3.5 million shares in the company lapsed. All allegations made by Mr. Simpkins in the proceedings have been withdrawn. So we saw this and thought, oh, well, that's a lot of money in legal fees, and it's a big payoff for somebody who was earning £300,000 a year before. What are these allegations? So we went to the High Court to get the documents in this case, to look at what allegations Mr. Simpkin had been making. And, you know, take into account the finance director is one of the most senior positions in the company, so he was, you know, a serious player. And published this story as a result. Barclay Group bosses accused of engaging in years of bribery. So what happened is Mr. Simpkin left the company. He was fired by Barclay Homes without any notice. And he alleges in his court case that the reason why, well, there was two court cases. In one court case, he alleged that the reason why he had been fired is because he had raised concerns about bribery at the company. And the bribery went right to the top, right to Mr. Pidgley, who was the guy earning £20 million a year. And he also alleged that, well, he alleged specifically that this bribery was towards an estate agent, as somebody who deals in land. So who kind of, estate agent is somebody who kind of does land transactions, and the bribery was there to kind of make sure that the company got the land in order to build their homes. And he bribed this estate agent by giving him gifts, a loan which was written off, free work on his property. Mr. Simpkin also alleged that Pidgley, the chairman, benefited from around £660,000 of money that had been used to kind of do up the guy's flat on the pretense that it had been used as a show home. Staff at Barclay were pressurized to make false claims in order to recover VAT, value-added tax. And there'd been inappropriate payments by the company to the son of Tony Pidgley. And there were some allegations of insider trading as well, in that the managing director had given price-sensitive information about the company to a major shareholder. Now, obviously, I should tell you that Barclay strenuously deny all of the allegations, and they say that they had a law firm come in and look at the allegations, and a law firm and a QC, and that they did a report and found that the company had done nothing wrong. They've not published that report, but it just so you know, we don't know whether the allegations are true or not. I mean, what we do know is that they were made now, and we know that Barclay paid a lot of money in order to settle the case, even if they claim that they have had a law firm look into them and clear them of any wrongdoing. And this came from just looking at the company accounts, right? Just looking and seeing that little note which said there'd been the payment to the former director, and that the allegations had been dropped, even though, you know, they didn't really need to say that. But, I mean, I think they made a mistake saying that, because it was just a bit of a red flag. And then we just kind of pulled at that thread, went to get those documents, and then could produce this kind of story from it. So it shows the kind of importance. Yes.
What kind of documents did you go to fetch on, you know, that was an Access to Information Act? Sorry. Okay, sorry. So the question was, what kind of documents did you did you obtain on on the tip from
Oh,
the
from
accounting
accounts?
books?
Well, I mean, we basically got the court case. So we got the filings on the court case, the statement of case from Mr. Simpkin, what he was setting out in terms of his court case, and the response from Barclay. I mean, the interesting thing is a bit of a side story, but there was two cases. One was in the Employment Tribunal, which deals with employment matters, and that's where all these allegations were made. And the Employment Tribunal is quite secret, and it's quite difficult to get information out of it, and we couldn't get any information out of it. And then there was a second claim where Mr. Simpkin was claiming that he was treated unfairly because he was fired without any kind of notice period, and he wasn't allowed to make his case about why he should be allowed to keep his bonus. It really had nothing to do with any of these allegations, but Barclay, in their defense documents, recited all of the allegations from the Employment Tribunal, thus putting them into the public domain and allowing us to go and report on them. I don't really know why they did that. I kind of have a suspicion that it might be to do with kind of trying to broaden out the scope of the case as much as possible in order to kind of make it more difficult to proceed. But in the end, it was kind of a mistake from them, because otherwise, if that hadn't have happened, we would not have been able to do this story. So another key report that you'll find in the annual accounts is the auditor's report. Now, the auditors are people who are supposedly independent, and they're meant to be the watchdogs of the corporate world, and they're employed by the shareholders to make sure that the management of the company is honest. And their job is to tell the shareholders that the accounts being presented to them are true and fair. And true and fair is important. I mean, the fair part of that is important, right? Because accounting is not just kind of adding up stuff. You know, it's not just like, look, here's one bottle, here's two bottles, I have two bottles. Lots of accounting involves opinions. You know, how much is this asset that I have worth? Well, that's an opinion. There's no right or wrong answer to that. And if and management of companies can do lots of stuff to massage the accounts by playing with those opinions, by overvaluing things, undervaluing things. So the auditor's job is to come in and to make sure that all those things are true and fair, and they sign off. And that's at the beginning is really high up in the accounts. You'll have the letter from the auditor. And in almost all cases, the auditor's letter will just say, yep, no problem, nothing to see here. There's a great book by my friend Richard Brooks called Bean Counters, which is about the accountancy profession and the failure of auditors to do their job properly. I highly recommend it. I'm not on commission. And so I looked up, when I was preparing for this presentation the other day, I looked up Zain's annual report. You're all familiar with Zain. It's the big mobile phone company, I think, based in Kuwait, but operations around. And what you have here is a qualified opinion. And that's quite rare from the auditor's letter. And that's what they say. What they mean by that is sometimes they can't fully sign off on the accounts. They can't say that these accounts are entirely okay and they represent a true and fair picture of the company. There's some important issue which provides some material uncertainty about the validity of the accounts. So it's a really kind of big deal when you have a qualified opinion. And then this one has also an emphasis of matter, which is kind of the step below. It's the between signing off and a qualification. I mean, if you can go beyond the qualified accounts, the auditor could just resign because he can't, you know, the things are such a disaster, but you never see that happen. They want to take the money. So the emphasis of matter is just saying to the shareholders, you know, you should, you know, we highlighting this as a concern, you know, we don't think it's big enough of a problem for us to provide a qualified opinion, but, you know, we're highlighting this issue which you should be aware of. So this has two. Now, unfortunately, this has been so pixelated that I can't even read it from here. But essentially, yes, so the basis for the qualified opinion is about the operations in Sudan, and that Sudan is experiencing hyperinflation, and there's certain accounting standards that you should adopt in those conditions, and they have some issue about those accounting standards. And then the emphasis of matter, it says, we now draw attention to Note 3 and to Note 27 to the consolidated financial statements, which describes the effect on the subsidiary in Iraq due to the current security situation there, and which discloses the uncertainty related to the outcome of various claims against it. Our opinion is not modified in these matters. So you think, oh, okay, well, what's going on in Iraq? Well, okay, security situation, you probably know what that's about. But what are the various claims against the company? I mean, that's interesting. So I went to have a look at this. It's such small print that, I mean, maybe I should have blown up it. But essentially, I think, from memory, looking at this last night, there's an issue in Iraq that there's a capital gains tax claim that the Iraqi government has over Zain, or is currently in negotiations with Zain about, and I think they probably haven't resolved that yet. So basically, the company is saying, well, we don't know what the outcome is that's going to be, so we might get landed with a bill, we might not get landed with a bill, etc. But that again is something to go and look at. Why have they got a capital gains tax liability, or why have they got a problem with the revenue authorities in Iraq? What's that about? Can you find out some more information about that, etc.? Sorry. Or can we give the microphone to this guy? Are you going to tell me what this is about?
عفوا اتصور المشكله الاساسيه لشركه زين بالعراق هي انه هم اوكي
Go for it.
اوكي اتصور ان المشكله الاساسيه لشركه زين ومعظم الشركات الاتصالات اللي تعمل بالعراق هي عدم دفع الرسوم السنويه، خاصه في بدايه العمل في العراق. وانه شركه زين هي حسب معلوماتي انه هي اخذت رخصه العمل من شركات اخرى اللي كانت في اتصور شركه اوراسكوم اللي المصريه اللي كانت تعمل في العراق. بالتالي هو ليست ضرائب مضافه، ولكن هي عدم دفع الرسوم السنويه، بالإضافة إلى مشكلة الفساد بين هيئات العمل الموجودة في هيئة الاتصالات الموجودة في العراق والشركات ذاتها، والدخول في أسواق مختلفة. يضاف لها نقطة أساسية أخرى، هي أنه في عام 2012 عملت تحقيق عن الأتاوات اللي كانت تجمعها تنظيم القاعدة بالعراق، من ضمنها أنه شركات الاتصالات كانت تدفع لتنظيم القاعدة حتى تستطيع العمل في المناطق الغير مؤمنة بشكل كلي، وبضمنها شركة زين وشركة آسيا سيل وكورك تيليكوم وشركات أخرى. شكرا.
Wow, interesting stuff. Okay, we all get that. Yes, you're right about Zain did take over the Orascom license. I mean, Naguib Sawiris, who owned Orascom, is on the record of saying is that the Iraq deal was the best deal he's ever made in his life. He said he spent $5 million on it, and he then sold it to Zain for $1.2 billion, which was 240 times the amount of invested. And so, I mean, if you see, or 200,000% increase in value, now you can see that might be an issue for capital gains. If there wasn't a capital gains tax paid on that, I don't know. I mean, this is all speculation from just looking at this and from what I know about the Orascom deal. And so on. So, these things provide clues to go provide further information. Right, so next we're going to go to the numbers. So the first thing you get to, I mean, again, somewhat irritatingly, although companies generally publish an income statement, a balance sheet, and a cash flow statement if they're bigger companies, they don't always call them the same things, and they don't always put them in the same order. So basically what the income statement is a profit and loss account. It's how much money the company has made or how much it has lost in any given year. And it's sometimes referred to as the statement of comprehensive income, particularly I think in America, because in the States, profit is often referred to as income, which is confusing because in the UK, income it often refers to revenue, which is not profit. And this is the consolidated income statement of our friends at Barclay Homes. So you've got here kind of the top line is always the turnover or the revenues, which is how much money, what's the total sales. This company builds and sells houses. That's what it does. So the turnover is the total value of houses they've sold in that year. And then underneath that you have the cost of sales. And the cost of sales is always the direct kind of costs associated with making the sales. So let's say if I was a mobile phone shop, right? If I was a mobile phone shop, my revenue would be the amount of mobile phones I sold in a year times the price of those mobile phones. And the cost of sales would be the amount I spent on buying those phones in order to sell to the customers. In this case, it would be the kind of building costs and that sort of thing. And then you get what's called the gross profit. So the gross profit is the turnover minus cost of sales. Underneath gross profit, you then have operating expenses. And those are often things that are kind of shared out amongst the group of companies or shared out amongst the company in total. It's the kind of thing that you can't attribute just to one particular sale. So it might be, for example, the cost of running your head office, or if you do lots of research and development into new products, that might be in the operations rather than in the cost of sales. Administrative expenses, things like that. And then after that, you have an operating profit. And in this case, Barclays' operating profit. The numbers here are, Barclays' revenue is basically £2 billion. Its cost of sales is £1.3 billion, which leaves it with a gross profit of £700 million. Operating expenses of £200 million. Operating profit, therefore, of £500 million. And then after the operating profit, you have finance costs. So if you've borrowed money and you have to pay interest on that money, that will come up in finance costs. And then that will be your profit before tax. You have your tax. And then finally, your total profits. Now, what I find interesting about income statements is if you start doing some very basic calculations to kind of get a sense of the profitability of the company. What is the operating profit as a percentage of the revenue? What is the total profit as a percentage of the revenue? And in this case, we could see that Barclay Homes is quite a profitable company. I mean, in terms of operating profit, it's like 500 million over 2 billion, so it's like 25% operating profit. So on every home it sells, it's making an operating profit of 25%. And then it has no finance costs, basically, because it didn't borrow any money and it's equity financed. So, this is a company making a substantial amount of money on the sale of homes. Now, the reason why this was interesting is because we looked at what they were telling local authorities when they came to build the homes. So in the area where the homes were being built, they needed to go to the local government and they needed to get permission. And the local government comes and says, well, yes, it's nice you're building homes, but can you also build a park? Can you build some affordable housing for lower income people, etc.? And Berkeley would always say, oh, we can't afford to do that because we won't make much profit on this development. What this does is, gross up is take all of the, what the annual accounts do is take all of the operations of the company and put it into kind of one number. And the turnover, the whole turnover for the company. So you're not talking about individual developments, but if they're saying, and we found that they were doing this all of the time, and every single development that they were doing that we could find, apart from a few, there was kind of always this issue about, they were saying, oh, it's not very profitable, it's etc. And then we saw that actually this is really profitable. Most house builders are making less than this. They're doing very, very well. So it's that kind of thing you can do is, it's basic analysis of a company, looking at the profit and loss account. How much profit is it making? Is it a profitable company? Compare it to other companies in the same sector. They'll have different qualities. This is Starbucks. Starbucks became very controversial in the UK for not paying taxes. And you can see here that, this is Starbucks UK's account, so this is just from the UK. And you can see that they have a turnover of £400 million. It's a lot of coffee. It's a lot of even Starbucks coffee. And they have a cost of sales of £320 million, leaving them with a gross profit of around £80 million. So then on top of that, they have administrative expenses of like £110 million, leading to an operating loss of £30 million. They're losing money. They're losing money on coffee, on just making and selling coffee, before financing, before any of that stuff. And then they have some other losses, loss on disposal of fixed assets, interest charges of 2.7 million. So in the end, the loss before taxation is around 33 million in 2011 and 34 million in 2010. So, Starbucks is just, in the UK, a terrible operation, losing 4 million pounds a year. And as a result, it's not paying any taxes on its profit because it's not making any profit. So you don't pay any taxes on profit if you don't make profit. So, and then when people started looking back into Starbucks, they found it never made a profit in the UK. So, why does Starbucks exist in the UK? Is it some charitable enterprise wanting to give people great coffee at low prices that they can't afford? Or is something else going on here? So, one of the things you can do is look at another coffee chain. Because coffee is, it's not that different in terms of a commodity. You might buy some really nice 100% Arabica, nice coffee, and that will cost you lots of money. But, coffee you get from a shop is like coffee you get from a shop, isn't it? It's the pricing, all of that. It's not going to be wildly different. But it is wildly different in this case, because here you have Costa Coffee, which is an entirely UK-based coffee chain, just been bought by McDonald's a couple of months ago. And it makes £460 million in 2012, £380 million in 2011. So it's making more money than Starbucks. And its cost of sales are a fraction of what Starbucks are paying. So, what they're paying for their coffee beans and for the shops and all of that is just a tiny amount. A tiny amount. It's not quite a tiny amount. It's significantly less than what Starbucks is paying. And, I won't bore you with the details, but the end result is that the bottom line is that the profit for the period is £45 million in Costa and £34 million in the year before. And as a result, they've paid £17 million in taxes and £15 million in taxes the year before because they're making a profit. And they're making a decent profit. £50 million a year is nothing to be sniffed at. And why? They're similar-sized companies. They're operating in basically the same industry, providing the same product, and yet we have just fantastically different results. Find out more tomorrow, 11 a.m. But the point of this is to say is that you can compare companies with the sector, with other companies in the sector. And that's a really useful exercise to do to get a sense of the company. Is like how well it's doing compared to others, compared to other companies. Different sectors will also have different financial characteristics. So, retail, that's high turnover, low margin. So low profits, high turnover. You're not making a lot of profit on everything you sell in a retail business. Whereas technology, you tend to get very high profit margins. I think from memory, Facebook's global profit margin is like 50%. So every dollar of advertising they sell, they make a pure 50% profit. Whereas Amazon is like 2%. Because Amazon's a retailer. People lump Amazon and Facebook and stuff together as technology. They're not. Facebook is an advertising company. Amazon is a retailer. It's a shop. Infrastructure tends to have very high interest payments because they borrow money to build dams, pipes, whatever, railways. Right, so after your income statement, you have your balance sheet. Your balance sheet is your assets and your liabilities. It's what you owe and what you own. And the difference between a balance sheet and all the other things we're looking at is that the balance sheet is only on a single day of the year. So it's taken on a snapshot of the health of a company in 1 year. So I decided to get the accounts of SABIC, which is Saudi Arabian Basic Industrial Corporation, or Industries Corporation. Yeah. I think it's referred to as the seriously big chemical company, I think. And this is a very, very healthy company in terms of its finances. What you've got here is at the top a list of its assets, and those will be kind of like fixed assets, so factories, chemical plants, pipelines, real things that you can go and touch that take a lot of money to build, that are fixed into the ground. And then you have current assets, and that's kind of more like stocks, more things that it's selling, something, it might produce 1 unit of chemicals and have that in its tanks ready to sell to a customer, hasn't sold it yet, so it's just an asset waiting there to be sold. And so you see here, SABIC has, I think this is in Rials, it has, 200, is it in thousands of? Yes, it is. So, 204 billion non-current assets and 118 billion current assets. So, yeah, you can see here it's got inventories of 26 billion Rials, that's kind of stuff, that's what I'm talking about, like units of stuff waiting to be sold, that's their inventory. It's fairly stable, that's quite interesting. You can see like companies getting into trouble when their inventories are going up and up because it means they're not selling the stuff. And here you've got the liabilities, which is the other part of the balance. That's why it's a balance sheet. You have, ignore the bit at the top which says equity. It's not normally part of in that place anyway. You have non-current liabilities and current liabilities. So you have, non-current liabilities. Maybe if you raise money in the form of a bond, so you have to, you know that you have to pay this bond back in 2026. That's not a current liability because you're not paying it back within the next year. Current liabilities are things that you have to kind of do within the next year. So one here they have, for example, is trade payables, 18 billion, right? That might be they've commissioned some work from some contractors and they know they have to pay it because they've signed the contract and that sort of thing. And the thing is about SABIC is it's a very healthy company financially. You can see that. And you can see that because its total current liabilities are 48 billion riyals. And if you go back to the assets, it has 59 billion in cash. So, you know, it could just pay for all of its current liabilities in cash sitting in the bank tomorrow. That's quite a privileged position for a company. Normally they'd be expecting to kind of earn money throughout the year and pay off stuff during the year, but you know, they don't need to even. I mean, they have a lot of assets, they're well capitalized, not a lot of debt. This is an unhealthy company balance sheet. This is a company called BHS, which was a UK high street retailer, which was taken over by a guy called Sir Philip Green, and he sold it for £1 after years of taking money out of the company, and then shortly after, and he sold it to somebody who had no experience in running a retailer, and shortly afterwards the company collapsed and thousands of people lost their jobs and people's pensions got put at risk. And you can see here that the company has, you know, in complete contrast to SABIC, the company has £5.5 million in cash and £300 million in creditors falling liabilities that it has to pay within the next year. So it doesn't have the cash to pay the people that it knows it needs to pay within the next year. And as well, the company was loss-making, so you know it had serious issues in that sense. What you have here is it has you have, I think we got total assets maybe. Well, I have to look on here. Anyway, the point here is that basically the liabilities are larger than the assets of the company by about £250 million. So that what that means is that if everyone they owed money to came and said to them, we want our money back, and then the company sold everything it owned in order to pay back those people, it would still be £250 million in debt. I mean, this is a disaster waiting to happen, really.
في بعض الشركات يعني بتعمل زي اللي هو الإهلاك، بتخليه دايما بنسبة كبيرة علشان خاطر اللي هي الأرباح بتاعتها ما تكونش كتيرة. إزاي الواحد يعرف يفرق؟ يعني مثلا في مصر شركات الإسمنت مثلا يعني معدات ومش عارف وخلافه و اللي هي يعني بتبقى مثلا الإهلاك بيبقى مش عارف شي 150 مليون وهي مش عارف إيراداتها كذا. منين الواحد يعرف يعني إيه يفرق أو يعرف إذا كانت الشركة كذابة أو إذا كانت صادقة، خصوصا اللي هو الإهلاك ده تحديدا أنا عايز أفهمه يعني.
Well, a depreciation would show up in the profit and loss account, but also in the cash flow account, which we'll look at in a second. And depreciation is a real thing. I mean, if you buy equipment, you won't be able to sell that equipment for the same amount that you've bought it for, particularly after you've used it. It's like buying a car, right? If you buy a car and in 2 years' time, you won't be able to sell it for the same price that you bought it. And the difference is that's the depreciation. Now, in terms of like, are they being honest? They'll have to have rules about how they depreciate things. And that will be set out in the notes to the accounts. It will say, you know, there'll be, for example, a rule which says 25 years straight line depreciation. And what that means is they depreciate the asset from 100% to zero over 25 years in the same proportion every year. So there's a straight line between the two. And I guess, you know, you have to kind of then look at the rules about whether the rules accord with what is the custom, what is the custom in the industry, speak to people in the industry to, you know, get an idea of whether that's an appropriate figure or not in the depreciation, that sort of thing. Okay. So the cash flow statement, this doesn't, you won't always find this. The cash flow statement tends to be with much larger companies, and it's basically money in and money out. It is what it is, cash. And cash is king, as they say. Companies don't run out of profits, they run out of cash. And if companies run out of cash, that's when it's game over. So I took Bahrain duty-free as an example, because I was just picking random companies to look at. Now, Bahrain duty-free, you see here it has a cash flow statement where it starts with the cash generated from customers. So that's kind of like how much stuff it sells. And then it looks at the receipts from car promotions, which is, this is in Bahrainian dinars. So it's 650,000 dinars they make from those car promotions. You know, when you go to the airport and there's like, pay $100 and you can have a chance of winning this Lamborghini. They're making, a lot of people are doing it. A surprising amount. And then they've got, some other receipts. And then they kind of got the amount they paid for the purchases. They got 17 million dinars, payments on operating expenses, management fees. So this is the cash coming out. And that's the kind of operating cash flow. And you'd want to see that being positive, really. I mean, if you're like a retailer in particular, and you're losing money on just the day-to-day operations, you're paying more for the stuff that you're selling than you're getting from the shop, that's a problem. Then you have, underneath that, the cash flows from the investing activities. So they have other things. I mean, in this sense, Bahrainian duty-free apparently has dividends coming from companies. So they must own companies that maybe operate in other sectors, who knows. And they get a dividend from that. They have some bank deposits, this kind of thing. And then they paid a dividend of 6.5 million Bahrainian dinars. They've got to pay their zakat, that's in there as well. And then at the bottom, you've got the kind of final cash position of the company. And it's quite interesting here because you see that in 2016, I'm sorry, this is very difficult to read, but basically their cash position decreased from 11 million at the beginning of the year to 8.4 at the end of the year, and then in 2017, 8.4 at the beginning of the year to 2.6 at the end of the year. So they have like a lot of cash in the bank, but it's being whittled away, and they can't go on like this as a company. They can't continue without changing anything. I mean, it's not necessarily a sign that the company's any trouble, but for example, the last 2 years, they paid out a dividend of 5.7 million and 6.5 million dinars. Like, they might have to stop doing that in the future. Like, dividends are very much something that is a kind of choice of the company. They don't have to pay it if they don't have the money. And the amount of cash that they have is decreasing every year. So in order to stabilize that cash position, they might have to cut the dividend. So if I was an investor in the Bahrainian duty-free, that's a question I'd be asking the company. I'd say, I really like my dividend. I get it every year. I'm a big fan of it. And are you going to continue to be able to pay for it? And they might say, oh, yes, because we're expecting sales to increase. We're going to open another duty-free shop or whatever. But these are questions that are raised by these things. Right, the next, we're moving away from the numbers and going to the notes. The notes are the most interesting part of the accounts. So, they always say read the accounts from the back first. It's the details behind the numbers. And you'll see in the various things I've done before, you see there's these figures, there's the numbers here, but then there's a column here with just a series of numbers, 10, 11, 12, 13. Those are the references to the notes. So every line in the accounts, most of them, will have some sort of reference to a note in the back, which will explain a bit more about what that number means. So if there's something where you look at and you think, that doesn't look quite right, you go and look at the note. And so all sorts of stuff. So, I mean, I found in the notes to the Erascom accounts in Egypt, so this is when I looked at the Egypt accounts, they had this, don't panic, I'll read it slowly. And so this was a kind of note describing sanctions that had been, Erascom owns a mobile phone company in North Korea, which is obviously not everyone owns a mobile phone company in North Korea. I think they don't anymore, but at the time they did. The company has operations in the Democratic People's Republic of Korea, which is subject to international sanctions imposed by the European Union and the United States. And the company could commence operations in other countries which are subject to international sanctions. DPRK is subject to international, that's repeating. These sanctions have the effect of restricting financial transactions and the import and export of goods and services, including goods and services required to operate, maintain, and develop mobile networks. So it's basically saying these sanctions really could affect our business. Whilst these sanctions do not currently have a material impact on the operations of Korealink, the company's operating subsidiary in the DPRK. So Korealink is the company they own in DPRK. There can be no assurance that if international sanctions are changed or subject to enhanced enforcement, the company's operating subsidiary in DPRK will be able to finance its operations, transfer funds to and from the company, or operate its mobile network. So I've read this, and I found this very strange, because you could kind of think, okay, they have this company in North Korea. North Korea is subject to sanctions. I can totally understand how they might warn their investors that, maybe Kim Jong-un is going to do something crazy, and the US will impose more sanctions, and then we'll have a problem. And that's the bit about sanctions are changed, and that's reasonable. But subject to enhanced enforcement. I mean, what's enhanced enforcement mean? I mean, in my view, it means they're breaking sanctions, right? Because if you're not breaking sanctions, then no level of enforcement, enhanced or not, is going to affect your business, right? So to me, this was kind of an admission by Erascom that they are somehow evading sanctions on North Korea. Now, I then went and spoke to some kind of experts in the UN on North Korea and so on, and their response was like, well, it's Egypt. Egypt has always had a very good relationship with North Korea, going back to the 60s when North Korean pilots flew jets for the Egyptians. And they're not really, they don't have the sanctions, they're US and American sanctions, so I don't see the problem. But then I learned that Naguib Sawiris is a US citizen. And so he is personally liable for the US sanctions regime. And that his family own a US military contractor in the US. So that was potentially a problem. So we did a story on that, which was called the North Korea Connection, basically setting out how this company in North Korea was connected to this US defense contractor via Egypt, via Naguib Sawiris, and via a whole set of offshore companies running through Luxembourg and the Cayman Islands. And that the US seemed to have no knowledge of this. And comically, the Sawiris's US, well, his family's US company owned the Pearl Harbor Visitor Center, amongst other things in the US. this was a very interesting disclosure made in the accounts of a company called Camec, which was listed on the UK Stock Exchange and owned by a former cricket player. And what it says here is that in April 2008, the company raised £100 million through the placing of new shares. I mean, some detail about that. So basically, the company issued new shares and sold them for $100 million. On April the 11th, so a few days later, the company acquired 100% of Lefevre Finance Limited, a British Virgin Islands company. Lefevre owns 60% of Total Mining, a Zimbabwean company, which in turn has the rights to certain platinum concessions in Zimbabwe. The purchase consideration was a cash payment of $5 million US. And in addition, the company agreed to advance Lefevre an amount of $100 million by way of a loan to enable Lefevre to comply with its contractual obligations to the government of the Republic of Zimbabwe. So again, in kind of boring language, what this is describing is this company selling shares, raising £100 million, and then loaning $100 million, which is not that much less, to the government of Zimbabwe, or getting most of that £100 million into the hands of the government of Zimbabwe. Now, the significance of this is that in 2008, inflation in Zimbabwe was running at 500,000%, and the total value of all of the currency in the Zimbabwean economy was estimated to be just $100 million. So this one deal doubled the amount of currency in the Zimbabwean economy. We're talking ridiculous sums here. And the money came in, 9th of April, 11th of April, etc. That came in that was just days after Mugabe had lost the first round of elections to the Movement for Democratic Change. And in the days following, ahead of the second round, there was 200 people killed, 5,000 people were beaten and tortured, 36,000 people were displaced. And an opposition spokesman has said all of the heartache, pain, gerrymandering, violence, intimidation, repression that took place in the 2008 election is directly linked to that 100 million. So basically this was kind of, and the company that raised the money, that put the money in, was ARIJ18. And in another bribery case in Congo, the prosecution documents revealed that employees knew that the money had been used to buy weapons and a boat from China. For, I think this money here. So this is kind of, again, this is a disclosure made in a UK company's house of a UK registered company, which gives you this detail about what essentially is a bribe paid to the government of Zimbabwe in order to get these mining rights. The mining rights had been taken from, I think, Rio Tinto, I can't remember exactly, just a few days before. So this is, it just shows how companies have to publish this stuff. They don't want to publish this stuff. I don't think they would want to publish this stuff. Because they have to publish this stuff, they put it in as neutral language as possible. This is note 36 to the accounts of this company. It's buried at the bottom, and it's in a country far, far away, but it shows the kind of stuff that you can find, these kind of diamonds in the rough, if you're looking at these kinds of companies. Searching around company's house last night, I found that Sonatrach, the Algerian petroleum company, They have a company in the UK, which is registered in the UK, which is actually a British Virgin Islands company. And they say what the company holding structure is, just this bit. So this was Sonatrach Petroleum Corporation. So the immediate control of the company is held by Sonatrach International Holding Corporation, a company incorporated in the British Virgin Islands, which is ultimately owned by Sonatrach Spa, a wholly owned Algerian state company. So, for that bit of information, you can then start piecing together a little structure of the company. You know that Sonatrach Spa, the Algerian state company, it owns Sonatrach International Holding Corporation, which is in the British Virgin Islands, and it owns this corporation, and maybe you can then go to those companies and piece together a bit more and start working out the thing. How are we doing for time? This is a long session, isn't it? I'll try and, anyway, so, Vodafone, I did a story on Vodafone. Again, all based off the notes to the accounts. And what we found was that there was these loans in the accounts of the South African part of Vodafone. And the loans were to people who were shareholders in Vodacom Tanzania. So the Tanzanian part of Vodafone had external shareholders, and Vodafone in South Africa was loaning money to these shareholders. And basically what we managed to unpick is that there was an agreement between the shareholders in Vodacom Tanzania that the investors would all loan money to Vodacom Tanzania in order to help them build the stuff they needed to build to make a mobile phone network, to put the towers in the ground, open shops, print scratch cards, etc. And one of the investors was a guy called Rostam Aziz, and he either didn't have the money to loan to Vodacom Tanzania, or he didn't want to loan the money to Vodacom Tanzania. So Vodacom South Africa loaned him the money in order to loan back to Vodafone Tanzania. In the accounts of Vodafone, it said that Aziz's company owed Vodacom, a total of $52 million. That figure was disputed by Aziz. But 2 years later, he sold his half of the holding company that owned the shares in Vodacom for $240 million. So basically, he was given this money by Vodacom in order to invest in the company. The company does well. He sells a share in the company, or given, he was loaned the money. But, he sells the company for half of it for $240 million. So he's made a huge amount of money facilitated by a loan from the company that he's involved in, which is kind of very interesting, to say the least. Rostam Aziz was the member of parliament in Tanzania. He was the fundraiser for the president. He was a very, very powerful man in Tanzania, which also made that a particularly interesting case. Right, everything I've told you so far is kind of predicated on the idea that that the accounts are telling you the truth, but they don't always tell you the truth. So, and that's when people are cooking the books. So, why do you cook the books? How do you cook the books? Well, first of all, why would you want to commit accounting fraud? First of all, you might want to hit the numbers. So, two key metrics about how to value a company: earnings per share and the price-earnings ratio. Earnings per share is basically you take the profits of the company and divide it by the amount of shares there are, so that you know the amount of profits made for each share of the company. And the price-earnings ratio is the price of the company's stock on the stock exchange. You wouldn't normally do a price-earnings for a private company. and that's divided by the earnings per share figure to give you a sense of how much people are willing to pay for every dollar of earnings the company is making. Now, these things are really, really important because analysts, stock market analysts, look at these metrics. They make predictions about the future. They'll say, okay, next year we think that Zain or whatever is going to make X earnings per share, and that will impact the price-earnings ratio. So that will mean that the price of the stock will go up or down if it manages. And then if it doesn't meet those numbers, then investors lose faith in the company. They start selling out. The share price takes a dive. The bonuses of the executives of the company might be predicated on hitting some of these numbers. So it might be that the company can only pay out a bonus to the chief executive if it manages to hit certain targets. And so, they want to make sure they do. And there may be tax reasons. But that will be more on the other side. That would be more depressing the earnings. You may want to pretend your company is not making any profits when it is. You might want to, for example, start booking the revenues to an offshore company and not having much in your local company in order to not show much to the tax man. And so lots of accounting, well, basically all accounting fraud is about trying to manipulate these things. And there's a couple of examples from recent history. So it's this story about Toshiba. The boss quits over a £780 million accounting scandal, which is a lot of money. And here you say, he said that improper accounting at Toshiba, including overstatements and booking profits early, or pushing back the recording of losses or charges. Those actions often resulted in still higher targets being set for business divisions in the following period. This led to the need to carry out improper accounting on an even bigger scale, and as this was repeated, the scale of the inappropriate bookkeeping expanded. So this is the real problem with accounting fraud, is that it's difficult to do it just once. It's like once, see, if you miss your target 1 year and therefore you're going to miss your target and therefore you want to commit accounting fraud in order to make the target, it just becomes more difficult to meet the target the following year, right? Because then you just have a bigger gap to fill. And this was what was happening at Toshiba. Toshiba, clearly, they wanted to, meet some targets and weren't doing that, so they started massaging the accounts, and in this case, booking profits early. So, they would say, for example, oh, well, we know we're going to get business from this customer next year, so why don't we just say that that's profit from this year, right? Or pushing back costs, so, etc. And then what happened is that the management would say, great, you met your targets, and now we're going to give you an increased target for next year. But you haven't really met the target because you've cooked the books, so that means you just need to commit more accounting fraud in the second year. And more and more and more and more until the end you get to £780 million worth of accounting fraud, and it's a big problem. Yesterday, the former CEO of a company called Autonomy was charged by the US authorities for fraud. And this was over a company called, yeah, of course. Yeah, just to use the things so they can do the
No,
video.
I didn't understand how it happened, how the fraud it happened.
Right.
Could you explain it?
Yeah. So basically, I don't know much about the case other than what the article is saying, but it's basically, yeah. Generally, we have a concept of, let's say, a business as like a shop or something very tangible, right? You come to me, you pay me for this bottle of water, and then I get money for it, and then I put that in the cash machine, and that's cash, and that's the accounts. But lots of businesses have much more complex relationships about how they would consider something to be revenue. So let's say you're the Toshiba does everything. They're just this massive conglomerate, from making cars to computers rather to air conditioning, but they also do contracts for government and so on. And contracts, there are really, they can be manipulated in order to increase revenues. So what you can do, for example, is you can say, I'm fairly certain that I'm going to get a government contract next year to build, I don't know, a new bridge, right, whatever. And so because I'm missing my targets this year, what I'm going to do is I'm going to take that revenue that I know I'm going to get next year and I'm going to put it in this year's accounts. Because in my opinion, it's as good as in the bank, because we're going to get it. And those kinds of issues around revenue recognition, it's called revenue recognition, which is how you recognize revenue. Or you might also have, and this was, I think, what was happening with Autonomy, which is the next company, is that they were having like long-term contracts. And in those contracts, there would be certain kind of conditions they'd meet along the way. So for example, it would say, or put it in another context, take it out of that. So let's say you're doing an investigation, right? And you're commissioned by ARIJ to do an investigation. And ARIJ say, okay, we're going to give you 20% of the money when you start and 80% of the money when you finish the investigation in a year's time. Now, what you might do is book 100% of that revenue as a profit today, and knowing that you're going to get the cash later, but that's a cash flow issue. But as a profit, you can say, like, I've got the contract and therefore the thing. And then you fail to complete the investigation, you don't get the 80% of the money, and then that's a problem. But you can bring forward kind of money that you're going to get in the future because you say, like, I've got the contract and therefore the money's there, really. And that's the kind of thing that Autonomy was doing, is they were making contracts which had lots of clauses in it that they would get the money at different points in the contract after different things had occurred, and they were bringing forward those things into the kind of current year's revenue in order to boost the amount of revenue in the account. Does that make things any clearer?
I understand the mechanism, but how you, as a journalist, you can discover that?
Ah, right. Okay. That is a more interesting question. I mean, it's difficult. I think you couldn't, from the accounts, just look at a set of accounts and say, oh, this company is engaged in accounting fraud. You might look at certain things, like in their policies, they'll say how they recognize revenue, and you can have policies which are very aggressive and ones which are more conservative. And if they have a very aggressive policy, you might want to ask them questions about that. Why have they adopted a very aggressive policy? There's certain telltale signs about, because if they're booking profits, it needs to show up sometime as an asset at some point. Either the cash needs to come in or so on. You know, if the assets look kind of like unrealistic, can be a telltale sign. There was a company in India called Satyam Computers, and they ended up having to employ loads of staff because, you know, in order to make it look like they were getting business when they weren't. So, you know, are people sitting in offices doing nothing? Those kinds of things. It would be very difficult, I think. It's just something, I think, to be aware of, how it happens and why it happens, and when stories come out, and to understand them, what's happening, etc. Yeah, that's about as far as I can go, I think, on that. So yes, Autonomy yesterday. Autonomy was yesterday. The guy got charged by the US authorities. Obviously, he denies the charges. 14 counts of fraud. Autonomy was a company that was bought by Hewlett-Packard in 2011, I think, for $11 billion. And a year later, they had to make a stock market announcement to say that they had written down the value of that asset by $8 billion. So they think that the company was only worth $3 billion within a year of buying it for $11 billion. And that is a disaster. I mean, you know, that is just shocking from a company that they could do that happens. And a real question mark over how could they value something so much when it wasn't really worth that much in reality. And what the US authorities are alleging, which obviously Mr. Lynch denies, is that, that they were engaged in accounting fraud in order to make the company look more valuable than it really was, in order to get the sale to Hewlett-Packard, get the money in their pocket, walk off, then it's not their problem anymore. What the things it says here, there was a scheme to defraud, began in January 2009 and lasted until October 2011. The purpose of the scheme was to ensure that Autonomy's quarterly earnings looked positive, which would lead to the defendants being rewarded financially for the fabricated success. Additionally, the scheme was meant to inflate the company's stock price, making it appear to be a good acquisition target. The Department of Justice alleged that the executives were able to make Autonomy's sales higher than they actually were via a number of methods. The executives allegedly engaged in the practice of backdating the financial agreements that would let them record the sales in prior periods, presumably earning the company some fraudulent tax benefit. They also allegedly recorded sales on contracts without mentioning unspecified contingencies that would have otherwise impacted the revenue recognition, the filing said. So that's the issue that I was just talking about, is that the contracts had certain contingencies in them that they weren't kind of declaring, which allowed them to book them earlier. And then auditors, analysts, and regulators were all misled. The executives allegedly lied to an independent auditor about the way where the company records sales. They also made false and misleading statements to market analysts covering the company to give the appearance that Autonomy's financial health and future business growth was better than it actually was. When regulators contacted the company over its financial statements, the executives allegedly lied to them. So pretty serious allegations being made. Right, I just want to move on to offshore companies. So it's great that companies publish these things, where they publish these things, when they publish these things, all the information. But unfortunately, many countries do not compel companies to publish accounts. Stock market listed companies will generally publish accounts, but if you're a privately owned company, let's say you have a single shareholder, in many, many countries you don't need to publish your accounts. So the Tax Justice Network does their Financial Secrecy Index every couple of years, which basically looks at this issue and other issues around financial secrecy. How secretive countries are. And you see Switzerland, you've got Switzerland at the top, Hong Kong and the USA. I don't know if this is the latest edition. Maybe it isn't. I should know. Singapore, Cayman Islands, Luxembourg. Now, their estimate is that $32 trillion of wealth is held in these locations. Private wealth is held in these kind of offshore locations. And then there was an interesting statistic that James Henry put together, which is that in just 5 African nations, Angola, Gabon, Nigeria, South Africa, and Sudan, there was $640 billion of offshore wealth in 2014, which dwarfed the combined external debts of those countries of $225 billion. So the amount held offshore by private individuals from those countries is more than the total external debt of those countries. UNCTAD say this is 30% of all cross-border investments goes through tax havens. And this was a story I did about Liberia. So Liberia is kind of one of the world's unknown tax havens, or lesser known tax havens. This building is the LISCA building. It's the Liberian International Corporate and Shipping Registry. I think there was, from memory, we think about 30 to 40,000 companies registered to this building. And the strange thing about this building is that all of the companies registered there are registered to a place called Broad Street, which is in Monrovia in Liberia. And I went to Liberia, and it was, I think it was 40 Broad Street, or some number in Broad Street. And we found Broad Street, and it has no numbers. So then I'm like walking around, and you see the addresses of places. It's like if someone writes their address, they'll say, on the corner of Broad Street and X, across the road from the big church, Monrovia, Liberia. Right? That's how they do the addresses in Liberia. So the 40 Broad Street just didn't exist as an address. And so then we went to a DHL office and said, okay, well, if we gave you a letter with 40 Broad Street written on it, where would you post it to? And they said, oh, we'd post it to the LISCA building on 5th Street, which was like 3 kilometers away. So went there and turned up and asked whether anyone would speak to us and what they do there. And they was like, no. Oh, the guy who runs it was on sick leave in the United States for the last 3 months, apparently. That's kind of basically the post office of it, or the mail room, or the mail comes in there and then they scan it. And the real registry is in Virginia in the United States. So the Liberian Corporate Registry is actually located in the US. I mean, it's a very weird place, really. It sets up these non-resident companies which are only available to foreigners. So if you're a Liberian citizen, you're not allowed to set one up. They have no income tax liability. They've got no obligation to declare who their owners or directors are. The directors can be nominees. There's no obligation to file annual accounts. And through this mechanism, the real address of the company is kept confidential because they know where the person who really owns the company resides, but on the company address is all of this mailroom here. And it can issue bearer shares. Do you know what bearer shares are? Bearer shares are basically like a share certificate. So, if you own shares in a company, you're the owner of a company, you'll have some sort of register normally where it's written down who owns the company. But in bearer shares, it's just written on a piece of paper without a name. Well, sorry, it's not written on a piece of paper. It's just written, whoever holds this piece of paper is the owner of the company. So, I could just put a £50 million in a bank account in Switzerland, and then the Liberian company owns the bank account, and then I just hand you the piece of paper, and you're now the owner of the bank account, or the company with the bank account, and no record of the transaction ever taking place exists, which is why they are kind of an amazing instrument of secrecy. I think they're cracking down on the bearer shares thing, though. But now all of this is yours for $400 in 24 hours online.
عفوا، هل تقصد أنه التسجيل في هذه الشركة الهدف الأساسي في هذا المبنى الهدف الأساسي منه أنه يحصلوا على هذه الشهادة أنه يخبئوا الأموال في سويسرا؟ أنا هذا اللي فهمته.
Well, I mean, not just in Switzerland. I mean, yes.
For example, I mean.
Yeah, it's you can't just libel the whole of 40,000 companies by saying anyone who has a Liberian offshore company is definitely trying to hide money. I mean, but I think it's very difficult to understand why you would open up that kind of structure without the intention of wanting to stop people knowing what your money is, where your money is, or who sits behind it. I mean, the one reason why lots of Liberian companies are set up is to do with shipping. So Liberia has a massive shipping registry. I think it's like the second largest shipping registry in the world. Huge amount of ocean-going container ships, etc., have Liberian flags. So then they'll set up a company which goes alongside the ship and owns the ship, and that's just convenience. But I mean, I would really question if you were not a Liberian citizen and you weren't owning a ship and you owned a Liberian company, it would be very interesting to know why you did that. I mean, it's not just bank accounts in Switzerland, lots of property in London. I think we found about £300 million worth of property owned by Liberian companies. And not just Liberian companies. I mean, Liberia, I just put it there as an extreme example, but British Virgin Islands companies are a very effective way of preventing people knowing who sits behind them. Now that tower here is, I mean, apart from being down the road from where I used to live, it's quite interesting because they did a study on it, and there's 214 properties in that tower, and in 184 of them, there's no one registered to vote. And 54 of them are owned by shell companies based in tax havens. So like, 25% is owned by shell companies in this tower. It's right opposite Parliament. It's very valuable property. Private Eye, this investigative newspaper or investigative magazine in the UK managed to get it wasn't a leak. I think somebody in the Freedom of Information department had a good day or a bad day, depending on which way you're looking at it, and gave them the data of all of the property in the UK owned by offshore companies. And they'd made this map, and this is just one part of London. Each purple dot is a leasehold property owned by an offshore company, and the orange things are kind of bits of land. And this big thing in the middle, this big black thing, is just a park. So, that's why there's no property there. But, having now depressed you, having first given you all this inspiration about what to find in company accounts, now depressed you about how you're not going to find it because it's all offshore, I'll give you some hope, which is that, and we'll finish with hope, which is that, not all, you can find some things offshore. Don't look at offshore as like a big black box from which nothing ever appears again. And through various, you can, like for example, the Netherlands it's not a secrecy jurisdiction, but lots of companies run things through the Netherlands. And you can find lots of details about companies in the Netherlands. The same with Luxembourg. Isle of Man, Guernsey, Jersey, right? They won't tell you who the owner of companies are, but they might tell you who the registered owner is, or who the directors are, and maybe somebody will make a mistake and put some more information than they required on there. Gibraltar has a company's house, Switzerland, etc. And apparently with the British Virgin Islands, you can kind of email them and get a form, and they'll give you like some basic information about a company, check if it exists, etc. And then, obviously there's the Panama Papers Offshore Leaks database on the ICIJ website. So, these are kind of, you won't find, Luxembourg and Netherlands, yes, but on the other ones, you wouldn't find necessarily annual accounts. But you might find, some piece of information that might help you track some sort of relationship between people. And that might be good enough for what you're doing. Okay, right. Well, that's more or less it. We've got a few minutes left. If anyone wanted to ask any questions or. Oh, yeah.
الملخصات او اللي هو التعريف اللي هي بتكون دايما في اخر الميزانيات. احنا كان في قصة اشتغلنا عليها من خلال ملخص زي كده او من خلال تعريف، يعني دايما بتكون مهمة. يعني كان شركة غاز مصرية مفروض ان هي اشترت نصيب من شركة غاز الشرق المتوسط يعني. فهم كانوا كاتبين تحت ان في شركة اوف شور هي اللي اشترت، يعني هم مش كاتبين هي اوف شور بس هم كاتبين ان هي مسجلة في لوكسمبورغ. فمن خلال اسم واحد بس عرفنا ان احنا نشتغل عليها يعني. فهي دايما بتكون اللي هي نوتس اللي تحت بتكون مهمة يعني. ما اعرفش انت فهمت وجهة نظري ولا لا، بس يعني دايما هي بتكون مهمة جدا اللي هي النوتس او اللي هي الملخصات اللي بتبقى تحت يعني.
Yeah, totally agree. Totally agree. Right, does anyone else want to ask anything, or we can wrap up and go for lunch? Maybe I shouldn't have put it like that. Okay, thanks very much everyone for listening to this possibly overly detailed presentation, but I hope you learned something and have something to take away.